Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy. Plus, global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
Hi, everyone. Welcome to the Bloomberg Businessweek Weekend Podcast. This week, clear themes and actions to address, including nonstop conversations around the now 1 week old U.S. war against Iran. Questions around the objectives, the timeline, and still the reason behind why the U.S. got into a war in the first place by a leader who calls himself the peace president. We'll hear one view on why the action was long overdue.
Also this week, persistent private credit concerns and worries about the AI spend and impact. Those were certainly two of the main topics at this week's Bloomberg Invest. It's an annual gathering of the top names in investing, deal making, and more to talk about the trends, tech, and top macro topics that shape public and private global markets. We'll hear from a few of them, including one person who's central to BNY's digital transformation.
And someone who gained notoriety thanks to Michael Lewis's The Big Short, and why he thinks the next systemic crack isn't in AI, but in the $2 trillion private credit market.
And then baseball legend turned broadcaster, investor, and team owner, and kind of our Bloomberg colleague. I think that's fair to say.
He definitely is.
Yeah. He certainly is like a Bloomberg colleague now, with his addiction to the Bloomberg terminal.
He said he was. He said he watches, he's addicted to the terminal, but now he also does a program, of course, with our own Jason Kelly.
We're talking about Alex Rodriguez on scoring home runs in his portfolio and what's on his playlist.
All of that to come. We begin with the conflict in Iran and what it means for the U.S. role around the world and for stability in the Middle East.
The president has long said the U.S. is done with nation building. Now he's embraced a form of intervention that harkens back to an earlier American era, openly targeting adversaries' leaders for death or arrest while offering few details about how the U.S. intends to manage the aftermath. We're talking not just about Iran, but also what happened a few weeks ago in Venezuela. For more, we're joined by Ed Price, a former British trade official. He's now senior non-resident fellow at New York University. And this is something that you have thought that the U.S. should do for a long period of time. Would you have chosen the U.S. do it this way?
I would have preferred the US do it in 2001, 25 years ago. But I'd also like to begin by saying I'm very sorry that American servicemen, service personnel have lost their lives. So I don't celebrate it, on the other hand. We've built our civilization on a Bible verse, Matthew 7:12, do unto others as you would have them do unto you. And we've assumed that others in the world agree with that somehow, implicitly or explicitly, and they don't. So now we're facing a war with Iran, particularly after October the 7th. They started something that they can't finish, and we're hitting back, and we have hand-wringing about that. I think it's frankly absurd.
We are at war.
Yes.
Is it a quick war? Is it a long war? How do we know?
Well, as Tim was saying, the doctrine has changed, right? Previously, unless things change, it was a case of go in with boots on the ground and try and build a democracy. I think the model this time is kill the bad guys and keep killing the bad guys until they do what they're told. If that sounds brutal, that's a model called terrorism, which is a model that Iran perfected over the last 50 or so years. So they're getting a taste of their own medicine. And
doesn't make it right.
It doesn't make it right, no, but again, we have to get the hierarchy right. It doesn't make it, it's not right for the West to sit around having its throat cut because of some abstract principle that I just mentioned from the good book. Now and again, you do have to go out of your way to find and kill the bad guys, period.
Would it have been better if some of the U.S.'s, and we don't actually know what has gone on, I guess, totally behind the scenes, or maybe we do, as we read the tea leaves, but would it have been better if the U.S. had some of its normal allies along for the ride?
It would be wonderful if there had been a real coalition of the willing this time, as we were promised last time. And it's disappointing to me as a British American that the United Kingdom is not full square behind this. But I think that
they said the U.S. couldn't use bases for certain air support.
I mean, that was painful. That was embarrassing. If we are at war, with our ally, we should get full square behind the Americans, and the Americans should be full square behind us. I mean, the Chinese are watching that, the Russians are watching that. So I think the Prime Minister has really gone off the rails here. But I mean, look, that's to one side, because if the UK is holding back, it's irrelevant. The United States and Israel have decided that enough is enough, and they've decided to take out the Supreme Leader. Well,
here we are, barely in the third month of the year, and already Nicolas Maduro has been taken out in Venezuela. The Ayatollah has been taken out in Iran. Who would this administration target next, if anyone?
Putin, Cuba, anyone. This is the whole point. We want our adversaries to wonder in the back of their minds if they're safe. We want them on edge. I think this is so confusing for a Western audience because we've grown up with the story of the Second World War, right? So if you're
the end of history.
Well, I mean, first of all, all of us are of an age that we had grandparents or parents involved in World War II, and they came back and said, basically, if you're the first mover, if you cross a frontier, if you kill someone, you are the bad guy. And that was true of Adolf Hitler. But it's not always and everywhere true. And actually, Iran and Russia have been in a covert war undeclared with us for years since Putin's been in power. And because it wasn't declared, and because it's indiscreet and it's online and it's cyber and that kind of thing, it's very, very hard for us to turn around and point at it in our, the way we think morally and say, you've done something wrong, you've broken Matthew 7:12, therefore we'll go to war. So frankly, it's quite refreshing.
Is it really that hard to do that? With the Russia invasion into Ukraine for a second time?
Ask former President Barack Obama. Okay, I mean, the Russians walked into Crimea in 2014. Right. We did nothing.
At the risk of labeling you something you're not, if somebody didn't know you and they were just tuning into this right now, maybe somebody who supports President Trump would hear what you're saying and say, you sound like an old school neocon. Somebody from the John Bolton School of International Relations or Dick Cheney. It seems to be what the view you're embracing right now.
It's worse.
And that seems to be a view that the president has tried to move away from.
Yes. It's worse than that. They would rightly accuse me of being a chicken hawk because I didn't serve in the military. I served in a civilian government role. So here I am, talking up a war. And I should be careful about that. And if anyone wants to criticize me for that, they should. But we are where we are. We are in the context that we're in. And as a red-blooded American, as a Westerner, I look at the way the world is going, and frankly, I'm scared. The Russians have moved to a permanent war footing. The Chinese have been planning for Taiwan for years. And the aforementioned President Barack Obama and the afore President Biden was weak. They were weak in foreign affairs. So again, what I'd like to do is see the West flip how we behave. We should have more Matthew 7:12 at home and be kinder to each other here, because I am an opponent of the president and his domestic agenda, and we should be a little nastier and a little cruder with our enemies.
Is this also, you mentioned that President Putin should be scared. What about President Xi of China? And just this as President Trump gets ready to go over and visit.
There is a school of thought that taking out Venezuela, taking out Iran, is effectively pointing towards China. And you might look at President Trump's behavior towards Putin and say, actually, what we're trying to do is take the Russians out of the Chinese orbit long term, because the Russian energy supply side could actually help the Chinese if we close the Malacca Strait and so on. But why shouldn't foreign leaders be afraid that there is something that can go wrong? Why should we hand the world to authoritarians drip by drip?
So is it a message to President Xi also?
It might not be a message to President Xi, because I think that China's a much more serious player. But I think it's a good, strong message to the people who backed and planned October the 7th that there are consequences.
We're speaking with Ed Price, a senior fellow at New York University, also a former British trade official. He joins us here in the Bloomberg Interactive Brokers studio. What do you think the role of the U.S. should be when the missiles stop, when the bombs stop?
The examples in history where the United States has done best in these kinds of interventions is that in period one we go all out. Okay,
like what, for example? Like when did we do well in nation building?
Hiroshima, Nagasaki, and then 80 years of growth and peace in Japan. The reason we went wrong in Vietnam is that we didn't use our force. We were mealy-mouthed about it. Again, back to Matthew 7:12. You need to know when to apply the test of treating others as you would like to be treated versus when you are facing an adversary. an obnoxious regime which has oppressed women and funded terror in Iran, and thereafter provide the funding for whatever the best alternative is. That's how it's always worked. You go all out with force when you need to, and then afterwards you hang back and you fund the Democrats if you can find them.
Listen, I'm probably going to get a lot of hate mail, but what a country or government chooses to do in terms of its culture, I'm not agreeing, as you would guess. But I mean, is that the role of the United States? We've gotten into trouble trying to impose kind of our way on different parts of the world. So I understand terrorism, not a good thing, and we know the cost of that. But I'm just wondering, is that our role? If
women around the world choose to dress a certain way in accordance with their religion, that's none of our business. If the Iranian government is blinding women for daring to stand on a street corner, that is the American business, and that is what we should be in the world to prevent.
But at the same time, you've got a president, who maybe feels that way, but then when it comes to the importance of soft power helping...
That's not how the president feels, though. Is that why the president...
Yeah, I don't think it has anything to do with it.
That's why the U.S. struck Iran. I think I don't think that's that at all.
Again, this is when I start
and that's very anti-MAGA too. The whole idea of "Make America Great Again" is it doesn't matter what these other countries are doing as long as they're doing it within their. That's not in America's interest.
I'm trying to understand why. Right. I understand the history. Why now? Why? You go into war. Sometimes there's an imminent threat, or sometimes you make a choice because it could be an imminent threat in the future. And I get that. I just try to understand why now.
So this is when someone like me gets very confused. And I've said this before, small L liberal, who is a voracious critic of the president. I mean, I've got to the point where I'm biased. I can't stand the sight of the guy because I think he is a direct threat to domestic rule of law. And I'll say that until I'm blue in the face. At the same time, I don't understand how small L liberals or progressives or traditional conservatives or neocons or any part of the original pantheon of American politics can look at the oppression of women and the funding of terror and not say that is a bread and butter enemy. There's no way that this should be allowed. And I will go to my grave wondering why, after 2001, we went into Iraq, which seems to me wholly pointless other than for some sort of 20-year training exercise with live fire, okay? And not Iran. Iran has been behind all of this. And if we had done it differently 25 years ago, we would be living in a completely different reality now and probably wouldn't have President Donald Trump in the White House at all because we wouldn't have had those forever wars.
Our thanks to Ed Price. He's a former British trade official, now senior non-resident fellow at New York University. That conversation with Ed, we spoke to him early in the week. This was as the war with Iran continued to unfold. Catch up on all of the headlines by going over to Bloomberg.com and, of course, on the Bloomberg terminal. You can also watch and listen to Bloomberg this weekend, 7 a.m. Wall Street time on Bloomberg Radio and TV, YouTube, and Bloomberg Originals.
Coming up, from the front lines of war to the fault lines of the markets, we talk private credit and more.
The Big Short's Danny Moses joins us next. You're listening to Bloomberg Businessweek. This is Bloomberg.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
This year at Bloomberg Invest, the buzz was about adaptation. Investors navigating AI disruption, geopolitical shifts, and the high-speed convergence of public and private markets. Yet, as the cost of capital remains somewhat elevated, that convergence could be creating some visible friction.
We all remember those comments last fall. JP Morgan CEO Jamie Dimon, what he said about private credit, warning that, quote, when you see one cockroach, there are probably more. And just this past week, Jamie Dimon spoke with our own Lisa Abramowitz. He cautioned that there's, quote, a lot of complacency in the market and that inflation is one of the risks, referring to it as the skunk at the party.
He's always colorful.
I like that.
He's always colorful. He gives us phrases.
He's got a great turn of phrase.
He does. Yeah. He does indeed. Hey, someone also with a strong view on the market environment, Danny Moses. He is founder of Moses Ventures. He was a key protagonist in The Big Short and remains a leading skeptic of private credit. Danny joined us alongside Bloomberg News equities reporter Alexandra Semenova.
because you can't predict when we're going to have a downturn, but what might cause it. I'm in the camp that actually the stock market has added such a wealth effect to the economy that it actually could be the stock market selling off that actually slows the economy. So they're all kind of intermixed here. And the stuff we can talk about, what I said down there about private credit, I think it rhymes with previous cycles, but every cycle is different.
So let's go there and talk a little bit about how it rhymes with previous cycles. Where does it rhyme specifically, and what concerns you?
So the whole thing about this cycle is that it's not systemic. We don't have the risk. The banks aren't there, so we don't have to worry about depositors being at risk. The similarities are that the banks are lending to the private equity and private capital firms, right? That's going on. They did the same thing to the mortgage companies in 2004, 5, and 6, leading up to the crisis. What did they do? They provided warehouse lines to New Century or credit home lenders countrywide. So they went out, produced the mortgages. What did Wall Street do? They bought those mortgages, packaged them, and sent them out to CDOs, and everyone bought them.
Great old cycle, right?
Same cycle. The same institutions that are now buying, all this credit. And so as soon as Wall Street sees credit turn a little bit, what they'll do is the credit lines that they're now providing into that sector, they'll tweak it a little bit. They'll pull some back. Then what happens, you get left. The reason these mortgage companies went out of business was because they couldn't sell it anymore and it got stuck on their balance sheet. Chair got pulled. So then the real marks start happening when liquidity starts to dry up, and it exposes the leverage. So whenever liquidity dries up in any asset class, it exposes leverage, and no good asset goes unlevered is basically how it goes. So
it's been incredible, Danny, to see that stocks haven't been toppled by anything that has happened this year. We have so much geopolitical risk. We have AI concerns, private credit. What is going to be the headwind that actually sends us into a correction or worse?
I think it's unemployment. So earnings have been strong enough, I think, to carry the market. I think we've had a broadening out within the market, which has been healthy into other sectors other than tech, which is great. But I think you're starting to see trends potentially in employment. Now, this memo that came out last week that I'm sure you guys were talking about all week, this Trini memo about what AI could look like in 2028, the apocalypse, so to speak, there's some truth to it. And you have to imagine what can happen. So you get all the benefits of being efficient as a company, and your margins improve, so you get that now. But we saw already from Block what was said, firing 40% of their staff. OneNote literally took pages, it felt like, out of the memo and said, this is what we think we can do now, be more efficient. So those are white collar jobs, and so that's in the economy.
Well, to be fair, I think we're all trying to figure out, is that a Jack Dorsey figuring out the future of that company, right, in terms of management, and whether or not that is an indicator of what's to come.
And there are a lot of people who say that's not something that it's reduction in force that's sort of camouflaged as an AI. Like, this is bloating. We're going to be speaking about this a little later.
He certainly overhired probably post-pandemic, but what he said was irrefutable in terms of why he believes there'll be more efficiency and that he doesn't need humans to do all the jobs that they were doing before.
I want to go back, though, to over-leverage, because I always think about who's exposed ultimately. Like, what happens when the tide rolls out? And I'm just curious how you see potentially a crisis akin to the GFC happening because of private credit.
So I think in terms of it fueling the economy and economic growth, companies being able to access credit is great for employment, right? It's great for companies to, but maybe they otherwise wouldn't have gotten it, or maybe the leverage is too high, or maybe the covenants are too light that allow these companies to keep borrowing, modifying loans. As soon as the money stopped coming in, or slowed down, I should say, on the institutional side, what did we see? We saw private credit get offered on the retail channels. Well, some of these banks and brokers are incented to get it onto those channels. And that's my point. When retail investors get the opportunity all of a sudden to buy something,
right?
Caveat emptor.
Listen, we talk about this a lot.
Yeah, this is what we just talked about with Mike Contopoulos. I mean, the idea that it's a signal of something, that the market becomes more available, or what he said is it becomes more democratized. So in your view, not a good idea for the everyday investor to have access to these products?
If I were a retail investor right now looking to get myself exposure, I would be buying Blackstone, KKR, and Apollo. I'd be buying the parent companies, the large PE firms that have permanent capital, that have a huge fee income stream. That's how I would expose myself. And guess what? I can buy it and sell it in the same day.
You wouldn't be putting private credit.
I wouldn't be
private credit. Funds in your 401k.
If I had a retail broker that called me and offered me that, I don't think he'd be my retail broker anymore.
Buying those names are liquid, as you know, like Recover, right? These firms, you can sell and buy easily. But come on in, Alex, because I know you're listening.
Yeah, we're talking about retail investors, and I actually wanted to ask you, Danny, one new segment of finance that they're actually foraying into is prediction markets, with kind of the excess cash that they have to spend. What do you think that will look like later this year as prediction markets continue to grow?
Well, they're regulated by the CFTC. They've taken an extreme amount of market share from the traditional online sports books that we've seen. But it's really interesting because I actually use them as a way to follow the news. Not that you guys don't provide all the news that I need here, but you want to know what's going on in the election in Brazil, and you know that you want to either buy or sell Brazilian equities as a result. Watch those. Watch what's happening there. So you don't have to trade those markets, but you need to watch it. It's really interesting. One pops up, you're like, I never even thought of that. You know,
I mean, I've seen like Goldman Sachs, JP Morgan, a lot of big institutional firms citing prediction markets in their research notes really often now.
Right, and they're partnering in the media. They want to get it out there more. I get it. And listen, it's growing. It's a sector that's evolving, but sorry.
Please.
Finish.
No, it's all about
we talked
regulation.
about during the elections, right? Like, go ahead.
Exactly. It's where the regulator lies. It's not at the state level. It's at the federal level.
So that use case, I think, to a lot of people makes a lot of sense. But the question, and this is a real question that is available on some prediction markets, will Jesus return in 2026? Right. Yes or no? Doesn't necessarily carry the same weight, I think, with someone like you. That's a sign of something.
Yeah, well, I think there's an entertainment value. But I want to say, let me give an example of something that I just talked about on my show the other day, which is, will the U.S. debt exceed $50 trillion by the end of 2028. Even the CBO, which is nonpartisan, has literally 44 trillion. I'm negative on U.S. debt. That's a whole nother topic we can go into some other time. But if it hits 50 trillion, to your point, I say you trade no on that. Because if it's yes, we have a lot bigger issues. What, do we have another pandemic, another financial crisis? We bailed out private credit in the tune of 3 to 4 trillion. How did we get to 50 trillion? So when I see stuff like that, and it's trading at 50 cents, so it's trading at a 50% chance right now. I watch stuff like that to tell me, and if it starts to move, then I start to dig deeper. What am I missing?
You watch it, but you don't participate in it.
Oh, I participate in it.
Okay, how do you participate?
I trade on Kalshi. I mean, I trade these markets. Will the S&P close below 7,800? I trade yes. It will trade below 70 at the end of the year. Will gold outperform Bitcoin?
Right.
Yes, I believe it will. And it's interesting to see how they trade. Will the Fed cut? CME Fed Fund futures will match up directly what you will see on Kalshi in terms of, but I don't want to set up an account and trade Fed Fund futures, but I can just trade yes or no, the 4% chance that they're going to cut in March maybe. So it's
how much do you allocate to a platform like that?
Not a ton, but enough that it's entertaining.
Yeah.
So I do my NFL there now, during football season.
So does a lot of
I'm going to do my
people.
Masters there during the golf tournament, so use it all, but yeah.
I want to ask you, you said bail out of private credit. Do you think we get to that point?
Well, I would...
you said it.
Yes. No, if we got to that point. So let me ask you a question.
If we got to it.
If we got to that point. Jamie Dimon just mentioned that things are okay. My issue is that things are okay because the Fed keeps bailing us out. There's a moral hazard, and I believe it's in the back of people's minds that actually believe, if private credit goes, the Fed's going to have no choice but to bail it out, and they're probably right. It will have an impact on everything, impact on the banking system. Right. It won't bring it down. So I'm half kidding, but I'm not. So what did the TALF go again? A whole nother segment. But post-financial crisis, the TARP, the TALF, the PPIP, we ran out of acronyms, right? So we're going to come up with another one. It could be a vehicle the government subsidizes a period of time. What did they do during COVID? They bought the HYG. But people forget, pre-COVID, we were already going through an economic downturn, and it's kind of resurrected companies that otherwise shouldn't have been saved.
So if President Trump brings in a new Fed chair who is more comfortable with cutting rates, does this just fuel the problem or make it even bigger?
You hope Warsh will maintain some form of independence.
Do you think he will?
I hope he does.
Okay.
I don't know.
Because if he doesn't...
Yes. Well, then you're starting to see what will creep in. Yields will start to move higher on the longer end, anticipating that whatever they do to move short-term rates will fuel long-term rates potentially higher, and you start to ignore inflation. You cannot ignore right now that inflation has stopped going down.
Yeah.
And it's ticking back up. Is it just for a period of time? We don't know yet. But with oil now moving higher, it seems so it's something really to think about, the Fed's ability to cut rates from here. So.
Danny, Lisa asked Jamie Dimon this question. I thought it was a great one. Are you worried more about inflation or about an economic downturn?
He kind of said both go to that. I'm not that concerned about inflation. I'm worried about the question you just asked. If the Fed starts cutting in the face of inflation, what that would look like. I think the economy's fine, but I think that we got to watch employment really carefully, and I think that's what everyone's spooked by this AI memo that kind of came out. We're already seeing signs of that, of white-collar jobs getting lost. So.
Yeah.
We're speaking with Danny Moses, the founder of Moses Ventures, financial computer, and a host of a new weekly series, The Danny Moses Show on Scripps News. He joins us here in the Bloomberg Businessweek studio. Let's go back to what you were saying about AI and the economic effects of that and what that is on the labor market. And dig into the Citrini report a little bit, because you did mention there are parts of it that rang true and other parts not necessarily. And we'll use the Jack Dorsey block news as sort of a jumping off point. Those are white collar jobs The message was received and has been received. Is that something you see other companies doing over the next 18 months? Reduction in force of 40% and more.
The same way no one was allowed to say tariffs a year ago on their calls, like don't blame tariffs. They're not going to say it. But why wouldn't you as a company? You're a publicly traded company. You have shareholders. Your job is for margin expansion and to produce earnings. If you see the opportunity to do it, it's not a non-for-profit. You're going to do it. And so there's no question that these tools, if you believe the AI secular trade is real, which obviously it is, it's going to have an impact, and you're pro NVIDIA and you're pro all this stuff, then you have to believe there's an end user case for it, both in the consumer and company-wise. And so if that's the case, by definition, you'll be more efficient. I think my takeaway would be, the U.S. consumer finds a way to make jobs around it. It could be something that helps guide that technology. So there's always going to be movement in that, and we've seen massive changes occur. The .com in 2000, right? We heard there'd be no more Wall Street jobs in 2008. After that, it's over. Right. Finds a way to reinvent itself. So I just think it's a think piece to think about. Okay, but there's not a CEO, a competent one, that's not already thinking, how do I be more? That's even. Jamie said it, that they use it. Now, he didn't want to say they're firing people, but...
I mean, everybody's using it, and everyone is telling us that if you're not using it, you're falling behind. And we are planning a Bloomberg, not me, but our team, a Bloomberg Invest event that comes tomorrow, and there's a big AI thing that you and I are both involved in. And it's interesting, I've had some conversations about, people say what you should do right now is talk to a 25-year-old. They get how you can use these tools. And the idea is that there will be a dislocation, whether it's 5 years or 7 years or maybe a little bit longer, between maybe an older workforce who's not going to embrace these tools and then a younger workforce who will. And that will free them up from some kind of tedious tasks, but create new opportunities. Right. Do you not buy that argument at all, that that's ultimately where we end? And it's going to be uncomfortable perhaps, because education's maybe going to have to shift around a little bit and teach things that people maybe lose, or would learn on entry jobs that they're not going to. So there's a shift. So
you have lawyers, you have accountants, and now you're going to have AI tutors. So there you go. There's a whole new industry that could happen. No, but in all seriousness, no. But there are huge positives to it in terms of making every company more efficient, making U.S. consumers more efficient. So that comes with more productivity for everybody. So maybe there's an offset there. I think, again, back to this memo, we don't spend a lot of time on it. People that are saying yes, yay or nay on it, you got to read it. Because I guarantee it's a long read. I mean, it's a 30-minute.
What is everybody missing?
Just that it's a think piece to get, and it's logic. You can't refute that could happen, and it will happen in pieces. And like I said, yes, Dorsey example maybe is just a one-off or whatever it might be, but I do think you talk to any CEO, they're not going to tell you that necessarily, but you know. So somebody's spending CapEx for a reason. Somebody's plowing money into these privates for a reason. Somebody believes. You wouldn't be doing that unless you thought there was an economic benefit. Well, it's a zero-sum game to a degree. So you don't just increase productivity and everybody wins. I think there's winners and losers here. So
it was amazing, Danny. Just a couple of weeks ago, we saw entire sectors being sold off in tandem, just being dumped because some AI startup said that it was going to replace jobs. Have you ever seen anything like that in past crises? And if that happens again, how do traders navigate that?
Well, I mean, so that's software companies, SaaS companies that always thought that was the best model ever. Yeah, I saw it. Your bank's going to close down, so go get your money out and line up around the block, right? So what did that take? It was the FDIC to come in and say, no, we're okay, TARP, the banks are going to be fine. So yes, you see that panic happen. You saw stocks, you saw Bear Stearns go, you saw Lehman go. Things actually did happen. That even shocked us to a degree. So yes, you will always have whatever the kind of sector trade of the time is, and you will always get an overreaction and creates opportunity potential to buy.
Well, did you trade on any of that?
Which, on the software stuff?
Yeah.
Nah, I'm too negative. No, I'm kidding. No, I didn't buy. But there are names. There's always one-offs, and I think I will end with this. We're focused on AI and all these sectors. There's so much going on outside of just the technology trades you guys talk about. And all of a sudden, everybody's energy playbook's out in the last week or so. Like, oh, wow, these stocks are cheap if oil were to even stay at 65. These stocks are, and it's 3% of the S&P, 4% of the S&P.
Right.
Could be 7. So I just think there's always opportunity to move around. And there's certain sectors which will not get AI'd away. And so as a Wall Street participant, I think you need to focus.
We want to go back to risks, but what do you think? I mean, what do you find most interesting in the marketplace today?
Gold and things that no one was. Now everyone's on gold, but things.
And you're still on gold?
Yeah, still long gold. Long the gold miners. I think it's up trade. Yeah.
When do you stop that trade? Yeah.
Listen, it's a $35 trillion asset now. No one talks about the size of it, but it's really big. But geopolitics just reared its head again. debasement, inflation. It works in a lot of different ways, and it's really a play that central banks are incompetent to a degree, and they're going to do whatever they need to do. So if you think the way out of this, potentially, I just mentioned, is the end game of this bailing out private credit at some point? I don't know, but gold kind of prices all that in. But to your point, these stocks move. The gold miners are up, 100%, whatever they are. Of course, you have to take some off the table. So,
what about spot gold at 5,300?
I like it, but I play it through PHYS, which is a physical.
Okay.
So, but yes, there's ways to express it. But just I kind of watch the flows, watch what's going on, and you got to be smart with it. So I'm not giving advice here, but
retail also big participants in metals markets right now.
Yeah, metals, silver specifically. I think every metals market's a little bit different. I think the commodity trade is here to stay. I really do.
Yeah.
And so
we're all pulling out our old jewelry. And
exactly right.
I'm not
joking.
joking.
You can't even get on 47th Street. There's a line out the door. So
I'm not joking. Having said that, back to risks. Whether it's private credit, whether it's geopolitics, what do you see as, especially as we continue to see a president who seems to kind of do what he wants around the globe, in terms of either taking out leaders, for lack of a better word. So how do you factor in geopolitics? Because I'm kind of shocked at the trade today. I expected something much worse, and it was much worse overseas, but maybe that makes sense.
Alex and I were just talking about that before we came in, and I think a lot of this was priced in. So what did we see at the end of last week? Oil started to move higher, but not to the mid-70s, but West Texas moved up to, call it 68. Then you had treasury yields lower, and it was kind of odd. Treasury yields were moving lower in the face of higher inflation prints. You're like, well, is the economy slowing? What's happening? And gold was moving higher, and metals were. So you kind of got some. So today is more of a buy on the news type of event. So what happened today? The microcosm I'm looking at today is U.S. dollar rebounded.
Yeah.
The belief that the U.S. is still the ultimate power, the belief that we haven't, hurt all our relationships, so we can be a trusted partner. We got a little glimpse of what that could be, because war always rallies the dollar. I think it's short-lived. So to the point you're making, I think this is a kind of a false bounce. We forgot all of a sudden about the AI trade. You have this MFS in the UK blowing up, which would have been front page news on Friday and today if there's other stuff. So that's page 2 right now. But here's another, mortgage lending type, again, not systemic, but also just a sign that money has been circling around the globe trying to find a place to go, and sometimes it's too easy, it's too free. So I just think in general, and the last thing I'll say is I am very concerned about U.S. debt and debt to GDP. That's my big, I know it doesn't matter, no one cares.
But it should.
It matters, because one misstep here.
Well, when does it matter? When does it matter?
Well, again, I'm not going to call a failed auction in the 10-year yield, but when you start to issue more T-bills instead of 10-year notes, right? When you start to do those things, you by definition create refinancing and repricing risk down the road. So if inflation does come up and the Fed's hands are tied, all of a sudden these T-bills, which you're issuing instead of 10-year, because you don't want to put pressure on 10-year bonds, just doesn't work. And so all we did from 2008 on was just move the risk to the government balance sheet. But you're not going to outgrow it. You cannot. We are not going to run a surplus in this country. We're going to run a deficit. Is it 1 trillion, 2 trillion, or 3 trillion a year? I don't know. Back to the cow sheet, 50 trillion in the end of 2028. We're under 39 trillion right now. That's almost 12 trillion from here. So that's a big concern, because if our rates start to move higher, there's maybe so much to worry about. Just buy just buy stocks. Honestly, I don't even know. So
I got cash under the
mattress.
mattress.
I got cash, exactly.
Because you brought us all together. Got 30 seconds. You want to do the last question? We've got a minute left.
I guess, Danny, Wall Street retail investors have this penchant to buy the dip over and over again. And at what point does that backfire on them? Because it's worked so far over the last few years.
Just got about 30 seconds.
I think it's self-fulfilling. I think that even through the tariff crisis of last year, ongoing tariff crisis of last year, ETF flows remain positive. Mm-hmm. So passive has still been positive, but that comes down to one thing: employment. If people start to lose their jobs, they're not putting in monthly into 401k. So that would be where I see the risk.
Our thanks to Danny Moses, founder of Moses Ventures. Also a big thank you to Bloomberg News equities reporter Alexandra Semenova. You can catch the full conversation with Danny on our podcast feed.
Still ahead on Bloomberg Businessweek, coverage from Bloomberg Invest, including BNY's digital employees.
And a former MVP turned business operator and team owner on Capital Play in Sports. A-Rod joins us next. This is Bloomberg.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
So far, we've spent the hour talking about macro shocks and credit risks. Now we get to the actual plumbing of the financial system and the autonomous digital employees now running it.
Well, BNY is moving beyond the chatbot. As the world's largest custodian, the firm is deploying over 100 autonomous agents that don't just suggest code, but also execute high-stakes workflows. It allows the human to really focus on other tasks.
Leanne Russell is BNY's Global Head of Engineering and Chief Information Officer. She joined us from this week's Bloomberg Invest event in the heart of the financial district.
Well, BMY is at the heart of financial services markets, 241-year-old company.
Right.
So I have my foot in many camps across technology. Of course, cyber and resiliency is really important to a bank like BMY. But obviously, AI is becoming increasingly part of everything that we do at BMY and really helping us shape financial services for the future.
Is it how much of it is internal in terms of the processes and the workflows that you guys are doing? You're, a major custodian for so much. So is it also from what clients want in terms when it comes to AI? They're looking for functionality.
So in terms of what we've built, we have built our own platform, and it's called Eliza, named after the wife of Alexander Hamilton, who built BMY and a philanthropist in her own right. And we've built that ourselves. And it is a platform, and we are a platforms company, and Eliza is a platform itself. So we have built that. It's model agnostic. We use all the LLM providers and multi-agent, and that is an internal platform, but it's also something that we use to interact with our clients and help our clients perform better.
So give us a concrete example of what it can actually do.
We have 170 concrete examples. We are way beyond the use case scenarios and very much into production. So 170 different versions of Eliza that touches everything that we do. So some great examples: KYC, know your customer, onboarding customers onto the platform. We have a lot of customers and $59 trillion of assets under custody. And so we have taken our KYC process that would have taken a number of weeks down to 20 minutes.
How does that work? You type the person's name into this model, and it tells you whether or not this person is who they actually say they are?
Well, Eliza, in this case, for KYC, is a multi-agentic model. So you have 20 different agents who talk to each other. So there's multi-steps in that process, from knowing who the client is to linking them to their different accounts across BMY. So it's not just one single agent.
It's agentic AI. This is it in action.
In action. And we have, like I said, 170 versions of that across the bank
It
today.
sounds like you guys really kicked into high gear, over the last year in terms of AI. My understanding is 100% across your team, everybody's in it.
Yes.
How did you quickly ramp up? How difficult was it in terms of the process and the build and getting everybody on board and everybody functional in it?
Well, three things I say was the silver bullet in terms of our adoption. First of all, we have a CEO who's very, very AI savvy, Robin Vince. He comes from a background in banking, but he, is hands-on in the technology. He vibe codes, he uses it in his personal and professional life. So I think when you're CEO-led, I think that's a really foundational part of our platform. Then having our own platform. So our employees don't need to go...
You kind of have to have your own platform.
Yeah, they don't need to go into this different technology. Everything is an Eliza. It's our tech platform, but it's also our governance framework. It encompasses everything end to end. And then we really led with enablement. So instead of thinking about engineering, gatekeeping the technology, we said we're going to get all our employees trained in using Eliza. Almost everyone at the bank now uses Eliza. We did training last year. We had to reinvent the training program to get everyone to go deep.
Do you need less workers because of it? And I'm not trying to be but we're trying to understand, what is it replacing workers, or is it freeing up workers to do other stuff, which is helpful to an institution?
So we actually have two different versions of Eliza when it comes to agentic. So we had the solutions that we talked about, but we actually have digital employees. So employees who are not human, who have a human manager, who have their own login and work in the ecosystem. Now that sounds like counter to what you just asked, but the fact is these help our employees become superhuman, and they're doing tasks that quite frankly are quite mundane and freeing up our employees to do much more interesting work. For example, vulnerability management. No software engineer likes to do vulnerability management. They want to code new skills and new tools into the environment. So our digital employees take that part of their work away, and then that frees up our software engineers to work on the stuff that they, quite frankly, went to school to learn.
At a large organization, and to Carol's point, like BNY Mellon, how do you do this in a way that provides an incentive for people who don't actually want to adopt these? They think to themselves, wait a second, I don't want this to to take away my job. I don't want this to make me obsolete.
Well, I think the thing you have to do is, like, I totally understand why people feel like that, but when you train people to use the technology, I think people fear it less. So that's why we led on enablement, making sure that everyone had access to the best training. We did 100% by the middle of last year. We reinvented the whole training program. We gamified it. And when people can see how to use this technology as a superpower, they're much more inclined to use it to help them in their work than have the kind of reaction that you talked about.
Was it really easy to train everybody, or how long did it take?
We had a goal.
Curious.
65% in 25 was our goal. We made 99 by June.
Wow.
So I think the adoption, we talk about it a lot. Robin talks about it a lot. Our EC handshaked on having AI for everyone, for everything, everywhere, which was our mantra. And I would say it was just amazing how our employees really, really embraced Eliza as a technology that can help.
That was Leanne Russell, Chief Information Officer and Global Head of Engineering at BNY.
As we wrap up this hour, increasingly when we talk about asset classes, we need to include sports in the conversation. What used to be a world of family-owned teams has been transformed into a sophisticated landscape of private equity, massive media rights deals, and skyrocketing valuations.
Someone who sits at the intersection of all of this is Alex Rodriguez. He's chairman of A-Rod Corp. He's co-owner of the Minnesota Timberwolves and the Lynx. Alex is also the co-host of the Bloomberg podcast and Bloomberg Originals show The Deal with Jason Kelly and Alex Rodriguez. And we kicked off the conversation by reflecting on the live taping that he and Jason had just done at Bloomberg Invest. That was with the CEO of 6th Street, Alan Waxman.
Incredible story. I mean, his background, and he spent 10 years at Goldman Sachs, and he basically ran a $30 billion fund in which they can invest in any asset class, which really gave him a competitive advantage. He's now brought that over when he co-founded 6th Street 2009. They have over $100 billion in the AUM, and he's really deep in sports. He's done investments with all major leagues. He's done the San Francisco Giants baseball. He's done the Celtics and San Antonio Spurs in basketball. And he just bought a minority stake with Jonathan and Robert Kraft with the New England Patriots. Fascinating and great conversation.
I'm curious about the opportunities that he sees right now. And, obviously he's taking advantage of the new rules about being able to buy into different leagues, which is a whole conversation that we could have. But what really excites him when he looks forward?
I think a few things. I think markets, depending on what team, what leagues, what league, the leadership of the three leagues. Fortunately for us, we have Adam Silver, Roger Goodell in football, and Rob Manfred, all very established, very top-tier commissioners, so all that's good for him. And I think when you look at the NFL, the combination of appreciation and cash flow is something that's very, very unique in sports. You don't have usually both of those so aggressively. So baseball's an interesting situation. I think baseball's the best opportunity to invest today. I'm a contrarian by nature. So I would invest right into the teeth of this collective bargaining agreement.
Why?
Why? Because I think you can buy at very, very attractive multiples, and you're making, I think, two very safe bets. One, that the CBA will get better, not worse, right? And the second one is that Rob Manfred would take a page from Roger Goodell and consolidate all the regional sports rights and make it more into national rights. And you get an expansion in multiples.
So will there be a labor stoppage after this season?
I hope not. I don't know. But I've talked to members of both sides of the aisle, and they have said, meaning owners and players, and they're both dug in pretty strong.
So maybe is what you're saying.
So I don't know.
Would that change your view on investing in baseball?
No, I would invest even heavier into it. Because as you have more noise, as we've seen in the public markets the last couple of days, you have volatility.
Yeah.
Where you have apprehension, I think you have opportunity. And the multiples, if you can buy a baseball team at a 4 or 5 multiple versus other sports that are trading in mid-teens, I think that's an opportunity.
Would the players ever agree to a salary cap, you think?
I don't think so. I don't think so.
Should they or no?
I think I don't want to comment into that because I have friends on both sides.
Yeah,
but here's
fair.
what I would say. It should be a mentality about grow the pie as big as possible. How you guys divide it, that's a separate conversation.
Yeah.
But, going back to Marvin Miller when he started the union for Major League Baseball, which has always been very, very strong and highly regarded.
Yeah.
And the owners, there's been a lot of conflict over the last 5 decades. So how do you bring it together to say, let's work together to grow the pie as big as possible?
Why does it seem like baseball has the most issues with labor?
I think it has a lot
Am I right with that assessment?
Yeah. I mean, the history is very strong. Marvin Miller was the head of the union. He started it. Then that went to Don Fear for many years, who's a great, great leader. And then Michael Weiner, Tony Clark, and now they have a different situation right now. But it's been that way, Tim, since I was involved. I remember that every time CBA came, it was a battle. And somehow or another, you figured it out. But I will say that this is the most important year for baseball and labor talks in the history of the sport because of how many attractions we have out there between Netflix, YouTube, Bloomberg, you name it. There's just more assets that everyone's fighting for the consumer.
So do you think about the collective bargaining differently now that you're an owner of a sports team?
That's a great question. I think overall, like 90% of my thoughts are still the same. Is you want the sport to be healthy, you want it to grow, you want it to collect more fan base, and you want millions of people watching every day because it is a great sport. And the World Series this year showed us that when you have the right product, you have the right market, you have the right superstars in Vladimir Guerrero Jr. and Shohei Ohtani, that you had 53 million people watching when you include the U.S., Canada, and Japan.
Which is pretty incredible.
Baseball still works.
Yeah.
And when there's a lot of noise, there's a lot of opportunity.
So when you talked about, you're right, sports is vying for all of our attention with so many other things. So when you think about investing, how do you think about, like, how does that play into where you want to commit some money?
Well, you want to moat, right? Think about this. Take the NBA. If you're a real estate investor and there's only 30 beachfront properties in the entire world, boy, you would do anything to own one of those. So scarcity is a big deal. When you look at the TV deal that just was signed, 11 years, won the first year of 11 years for $77 billion, that's something that is easy to underwrite, easy to understand. So you like to invest into that, And then when you think about the global growth in the NBA, 20 years ago, there's probably less than 3% of the league was global athletes, meaning born outside of the U.S. Today, that number's ballooned to 35%, right? When you look at Europe, second most popular sport in Europe, the NBA, basketball, and is a $45 billion annual business, and we only own 1% of that. At the same time, you have 400 million people playing basketball in China, 300 million playing in India. So the global scope, you can say, from the American sports, NBA could be number one.
Our thanks to Alex Rodriguez. He's chairman and CEO of A-Rod Corp. He's the co-host of the Bloomberg podcast, The Deal. I guess he was also a very good baseball player, I'm told.
Like, I don't know if you Google, a few articles come up here and there. Yeah. All right. Be sure to catch all of our conversations from Bloomberg Invest. You can find it on our podcast page or by going to Bloomberg.com. And that wraps up the weekend edition of Bloomberg Businessweek from Bloomberg Radio. Thank you so much for joining us.
Be sure to tune into Bloomberg Businessweek daily, Monday through Friday. It starts at 2 p.m. Wall Street time on Bloomberg Radio, Bloomberg TV, and on SiriusXM channel 121.
You can also catch our daily broadcast on YouTube. Just search Bloomberg Podcasts. We're simulcast on Bloomberg Originals, available on Bloomberg.com/originals, and streaming platforms including Roku, Amazon Fire TV, Samsung TV Plus, and more.
Find our Bloomberg Businessweek podcast at Bloomberg.com, Apple, or wherever you get your podcasts. And the latest edition of the magazine. It's available on newsstands now at Bloomberg.com and always on the Bloomberg Terminal. I'm Tim Stenovec.
And I'm Carol Massar. Have a good and safe weekend, everyone. Don't forget to change your clocks. Stay with us. Today's top stories and global business headlines are coming up right now.
This is the Bloomberg Businessweek Daily Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.